Hi, everyone, and welcome to the week ahead. My name is Tony Nash. Today, we're joined by Adem Tumerkan. We're joined by Leo Nelissen and Albert Marko. Guys, thanks so much for joining us. We've got some key themes we're going into. They're kind of broad and simple, but we'll go into a lot of depth on them. The first is inflation and growth. The second is jobs. And finally, we'll dive into housing. So I know we could talk for probably 3 hours on these issues, but we're going to try to collapse it into probably 45 minutes. So before we get started, I want to let you know that we're extending our current promotion on CI markets. That's $25 a month for CI markets. It's $240 if you pay a year in advance for 1,700 assets. That includes individual stocks in the Dow, Nikkei, FTSE 100, Nikkei 100. We've just added the Sensex on the Bombay Stock Exchange, Sensex 30. We've got commodities, we've got currencies, we've got economic indicators from the top 50 countries, all forecast over a 12-month horizon with correlations, with error rates, comparability, export, and portfolios. So you can put all of your investments in a portfolio configuration and see how they'll work out over the next 12 months. So that is extended until Monday, September 4th. It's a holiday here in the US, so we're going to celebrate with everyone around the world. Get that stuff for $25 a month or $240 for a 12-month paid in advance subscription. Thanks very much. So guys, before we get started, just over the last few weeks, honestly, I've grown really, really weary of the hot takes of, the Fed's going to kill everybody and markets are going to die, or we're in a new bull market and you have to jump on. I mean, life doesn't work that way typically, okay? And the whole point of a soft landing is to kind of make markets a little bit boring, right? So, what am I off here? What are you guys seeing differently there?
No, I think that's right. I mean, the Federal Reserve, with all the rhetoric that's come out of, has talked about a soft landing and no recession and so on and so forth. And I know that people don't buy it, but look what they've done with oil and the market overall. Is they've kept us in this like range where they tempt you with an ultimate crash, and then they tempt you with market blow off top. With all these newsletter guys selling whatever they want to sell. But I mean, their intention is to destroy excess money, and they're doing
Yep.
a damn good job of that.
Yeah, that's a great point. I mean, extremes are really good for selling newsletters, right? But
Mm-hmm.
what the Fed is trying to achieve is kind of the slow suffocation of excess risk capital. That's really what they're trying to achieve, so that we don't have either of these extremes. Leo, what do you see on that?
I agree with Albert. It's basically, oil, equity markets, they're basically range bound. And last year I said, I'm not really a trader. I mainly invest on the long term. But I said, I think we're basically in a range between the mid 3,000 points and mid 4,000 points, where we are now, at the upper bound of that range. I think, risk reward is getting a little bad at these levels, especially if you look at inflation, heating up again. But I think in general, if you I post some bearish charts, some bullish, but if you post bearish charts, most people think you are very bearish.
Yep.
And it's always, as you just said, they're always extremes. And I think most people, when they trade, they always think in these extremes.
Yep.
So either we are going up 10% or down 10%. And I think that's very, very, very tricky. But as Albert said, it's a great way to reduce excess cash in the market and liquidity. But I think we could go down 10% again, but I don't have any trades on that. I'm just basically waiting, because it's just up to inflation, and we really need new signals from the Fed. Everything else is just noise.
Yep. Adam, what do you think on that?
Yeah, I agree. I run into that quite a bit on like Twitter and stuff. I get people, you post some data, whether it's good or bad, and then like half the crowd jumps on you, and then the other half of the crowd, just cheers it. So it's kind of weird. And I always try to tell people, like, nobody knows right. What'll happen. We're just all bumbling around trying to make our best guess with the data available in a very complex world. So I think it's important. You need to stay fluid and like adapt to the markets and not take it personally.
Yep.
I remember I learned a long time ago that don't confuse a profit and a loss with right or wrong. because rarely do those two actually align together. Like one's your opinion and then one's an actual outcome.
Yep.
So yeah, that's something I always try to tell people on those. But I agree. Like I think the market extremes right now are pretty steep. And we saw it last year. Everybody was expecting a hard landing. It missed. Now everyone's expecting a soft landing and they think it's fine. So that's what has me more worried now, is that everyone thinks it's a soft landing.
Well, yeah, I mean, it's a consensus that, whenever the consensus starts pushing out, whatever narrative they want to, usually it's wrong,
Yeah.
like the recession calls for Q3 and Q4 of, for the past year, look at recession, yet here we are with, no, I mean, it's debatable whether it's a real recession or not, but on paper, it's not,
Yep.
so that's where we're at here.
Good. So let's dig into that a little bit. So let's first talk about inflation and growth. So you tweeted this this statement from Nick Timiraos from the Wall Street Journal about PCE inflation. We saw both headline and core PCE rise in July. You've been talking about a resurgence of inflation in H2 for 6 months or something, I think. So let's talk about this data a little bit and tell us what happens from here. Does this get steeper? Does this taper off? What do you think happens here?
Well, it's a double-edged sword. We've talked about this a few times where inflation right now has given tailwinds to corporate earnings, which has driven the market up, which is exactly what, Yellen and all her other cohorts want to see, because, the market is the economy, as they keep saying nowadays. But that has after effects, second and third tier effects of like commodities rising, cost of goods rising, wage inflation rising, which in turn spurs CPI inflation. And the Fed's done the Fed and Treasury has done a magical job of concocting whatever data they want to give some kind of headline number, 3%, we're in the threes again, and we only need to be back down to 2. But, super core and core keeps rising. It's not going anywhere but up from here on in. And honestly, it's like it's been summer. Europe has been completely on vacation and in a zombie state for 6 months to a year now. The US is getting back to work. The holiday seasons are coming. Demand's going to start stepping up. I saw Keith McCullough had a chart out showing that luxury goods spending was down. Well, of course, but that coincides with people on vacation, not doing much. The service industry, it was still strong, but the consumers were still out there spending, but not as much as they were. But now here we come into the fall, the second half of the year, and into the first half of next year, and I expect demand to go right back up to where it was, 8-9 months ago.
Well, budgets are tightening. I mean, it's hard to argue with the fact that budgets are tightening generally, but that doesn't necessarily mean that, the economy takes a nosedive, right?
Yeah, of course. I mean, budgets are tightening for what, 60-70% of America, but realistically, the top 5% are the ones that are actually spending absurd amounts of money on luxury items, and they still will. I mean, when you go to a Gucci store or, a Chanel store, you have lines out the door of people that probably shouldn't be buying that sort of stuff.
Yeah, Leo, do you want to chime in?
Yeah, I think that's a great point. I mean, there's debate. Is the consumer strong? Is the consumer weak? I mean, that's been going on for over a year now. I've always been on the side of we have a weak consumer, but I think it's really what Albert says. On one hand, we have the more wealthier people, or people who pretend to be wealthy, who are still spending, and they keep. I think Ferrari also had new all-time high earnings and a great outlook, and all these companies. And on the other hand, the mass are actually in a very poor state. I mean, yesterday I tweeted the chart of one of my investments, Norfolk Southern, which is one of the biggest intermodal railroads, and it's just a mess right now. Demand for intermodal and all these things, and Dollar General is seeing massive demand issues and shrink. People stealing stuff. I think in general the consumer is in a very, very weak state. But as Albert already said, the upper, 10, 20, maybe 40% is keeping the economy alive. But I think we could get to a point where we are seeing more weakness, especially with inflation improving, increasing again. And if the Fed needs to keep rates elevated, that's going to really take a toll, especially with housing weakening and all these issues. So I'm not that bullish on the consumer for the next few quarters.
Yeah, it's again, it's another double-headed, sword here, because it's like double-edged sword, because the consumers are spending, but not in as much demand as they were maybe a couple of years ago. But companies are getting away with inflated prices because they know they can at the moment, and still can. But
it's weakening, Albert. It's weakening. I mean,
Yeah.
if you look at PepsiCo and its competition, I mean, even Wall Street, they said, we don't care for these companies that use only pricing to boost revenue. They really want companies that are, somehow able to boost volumes. And it's actually happening a lot. General Mills and all these companies are struggling now big time. I think for 2020, they were still able to boost volumes a little bit, but now that's completely gone. Generic
but
strong.
I agree for the general and the fundamental aspect of it. I totally agree. But when you have inflationary numbers pushing prices of services from the tech industry, which really is what the market is basing on, it gives you a skewed view of everything. Everyone thinks that earnings are great because Nvidia posts some horseshit number out there that they can't even justify, and then the market rallies 70, 80 points, and everyone's, the market's great, economy's great, so on and so forth. 80% of the US consumers can't buy bread. They have to choose between meals.
So, Albert, when you say inflation is persistent, you're talking about services inflation. You're not necessarily talking about goods inflation. Is that right?
I think goods inflation is starting to taper off as supply chains have become better. No question about that. But services has just gone through the roof, and housing has gone through the roof. Shelter, which is was a 30% component of CPI, is just still sky high right now.
Yeah, we'll talk about that in the last segment. It's really interesting to look at housing prices, and I can't wait to talk through that. So let's move over to growth. Adam, I'm really concerned about you tweeted a GDI versus GDP chart this week. And, we're told that the Atlanta Fed GDP now is close to 6%. I never believe the Atlanta Fed. When people tweet the Atlanta Fed, it just erodes their credibility to me. But we're seeing GDI at negative 5%. So what's happening here, and how could the acceleration of inflation, particularly services inflation, impact GDP and GDI?
GDP GDI is it's just, in theory, they should equal the same thing. For anyone who doesn't know, GDP is gross domestic product. It's what the economy produces, essentially, the output. And GDI is gross domestic income, the take in money from what was produced. So in theory, they should 1-to-1. They should go, be equal. But there are times in history where you see them start diverging, and we haven't really seen. And there's a lot of empirical evidence. Some St. Louis Fed individuals came out and they said actually GDI may be a better indicator than GDP, because historically GDP revisions drop down to match if GDI is below. The GDI predicted 2008, like 3 quarters before GDP did. So there's a lot of good evidence for why it's good, or worthwhile to use. And right now, so the US real GDI, gross domestic income, has been negative the last 3 quarters straight. So by those standards, technically we should be in a recession. Obviously that's an accounting difference between the two, but still. And there's Lacey Hunt does a good job. He posts if you average the two out, real GDP and real GDI, and it's basically showing that the US is growing at like 0.5 for the last 2 quarters. Like it's basically been flat if you average out the two.
That honestly sounds about right.
Yeah.
On a real or nominal basis?
On real.
Okay. Honestly, that's about right. Half a percent growth.
I mean, the nominal gap.
When I look around, that's what it seems like. When I look around in my daily life, that's what it seems like.
No, I mean, so it's interesting because we're seeing it fade. Granted, it was 0.5 in Q2, negative 0.5, and it was down over a percentage the last two, so it's down it a little. But we also saw GDP recently. Q2 got revised down from, it was about 2.4 to now 2.1. So that kind of narrows the gap between the two. But still, even if you average them out, it's 0.5. And I just don't see how the Atlanta Fed is 6%. Like, you know, I don't know if you saw yesterday's data. Also, the income and personal income and spending. Personal income came in very weak. It's been fading all year. It's now just 0.2 month over month for households. But then personal spending was at 0.8. So clearly you have to use debt to subsidize that gap or excess savings. Well, the St. Louis Feds posted a bunch of research, JP Morgan recently. They're saying that the excess savings is sub 500 billion at this point from June. And JP Morgan actually thinks that it's already exhausted for most Americans. And I don't see what the continued boom will be. I mean, consumer credit change, if you look at the year over year of credit change in the US, it's been declining the last 7 months pretty sharply. So if your real wages can't justify your spending, and it can't, like a big ticket item like a home, they're trading at a record high the median home price right now is like 7.75 to household income. So that means it would essentially take you 8 years of pre-tax household, that's 2 or more people, all money just to buy a house. So in cars, I think it's about like 45 weeks right now, average household income. Like if you just use all your money from 45 weeks on a 2-person household. So it's, you know, clearly these items, you need credit to subsidize the difference. So it puts the producers, like Leo was saying with Pepsi earlier, he brings up a good point, and we're seeing it in China too. You get to a point where if the consumer's not borrowing as much, and because they don't want to, either they're getting more nervous or they're just, you know, feeling tapped out, whatever the reason is, if they're not going to be taking on credit to buy these big ticket items, the producers have 2 things. They either have to let prices collapse or sink to invite more demand, but they usually don't want to do that, obviously, because it'll crush their margins. And then you have the other option, is that they will extend credit at favorable terms. And we've seen this in the housing market, right? New home builders doing mortgage buydowns, because you have to choose one or the other. You have to extend the game, keep the credit game going at a lower rate to move your inventory, or you have to let prices sink enough to move the inventory organically. And no one wants to do that option. You know, China's dealing with that right now, actually. So now America's doing this, and we're seeing Ford, all these companies trying to push credit to move their own inventory. And I guess we'll see if the consumer really wants to go onto it. I mean, it's better than what they can get at a bank right now.
Yep.
So, yeah.
So for a couple of comments, first, I think you said the average car would be 10 months of household income, right? Something like that.
Yeah.
So the average car that Albert buys would probably be about 5 years of average household income, I think.
That's about right. Yeah.
So that's my first comment. Second comment, since we're talking macro data, I'm thinking about a clothing line like truckers' hats and t-shirts that say always wait for the revision. I know I'd have like 5 customers, but you know, when I see these GDP numbers, especially on this chart that you put up with the wide yawning gap between GDP and GDI, I mean, that's not real. There's no way GDP is a real number. And there's no way that can't be revised way down in the coming quarters. I mean, this is just not real data. And I've said several times on this, employment data, wage data, retail price data is not right in any country. I've done detailed studies of that year over year. Everyone complains about China data. It's not just China. It's Sweden. It's the US. It's Germany. It's Japan. It's Australia. It's everywhere. Wages, retail sales, and so on. These are terrible data points. They're not right, and they're not settled until probably 3 years after. And check the 3rd revision on these things. In many cases, these will change by more than 50%. Okay, more than 50%. So we cannot trust these data. So it's not just wait for the 1st revision, wait for the 3rd revision for OECD countries. Terrible, terrible, terrible data. So is it possible that we have an environment where we have services inflation and goods price deflation?
Yeah, I think that can absolutely happen. I don't know. It depends on what rates are going down and what rates are going up, but I fully expect that to happen. Actually, probably into early next year.
Yeah, Q4, Q1. So services going up, services prices going up, goods prices not just disinflating but actually deflating.
Yeah, because I mean, they have a lot of inventory to get rid of. I mean, the holiday seasons are coming up. I mean, that stuff's got to get moved. You know, they have other stuff
Yep.
coming in spring and the summer. I mean, it's got to get pushed around. One of the other things is that Adam, I don't know if he talked about, but is wage inflation. That's certainly problematic for a lot of corporations right now. I mean, they're getting pressure to increase people's wages. A lot of it's from the Biden administration and the labor secretary, but the fact is they can't keep up those margins.
Yep.
So something's got to give. Either growth and margins are going to go down, or unemployment's going to have to tick up. But
Yep.
we see that. We see unemployment ticking up, especially
That's
with these
perfect.
revisions.
That's a perfect segue, Albert. So
Heads up for a short break.
Are you using the potential of AI in your portfolio management strategies? With an impressive 94.7% forecast accuracy on average, you can confidently integrate AI into your approach with CI markets. Visualize the potential volatility of your portfolio over the next 12 months and gain insights into specific assets that might experience fluctuations. This empowers you to make informed decisions on when to buy, sell, or hold. CI Markets covers a wide range of over 1,600 assets, including stocks, commodities, forex, indices, and economic indicators. Imagine running limitless portfolio scenarios to optimize your gains. Curious about the outcome of removing or adding certain assets? Wondering how your portfolio might evolve in the next 3, 6, or 12 months? CI Markets equips you with answers to these crucial questions. Whether you seek a streamlined portfolio analysis, wish to explore diverse scenarios, or aspire to track your investments with precision, CI Markets is the ultimate tool for you. Ready to learn more? Visit us at completeintel.com/markets.
Thank you. And now back to the show.
let's talk about jobs now. So, Leo, speaking of kind of something's got to give, you've been looking at the US jobs market and you tweeted about the challenger job cuts as well as the US JOLTS data. So as you look at this, what is this telling you? Are we closer to what the Fed may be looking for in terms of slowing down persistently hot jobs markets, or do we have a long way to go?
I mean, if you look at jobs data only, I think you can make the case that we are getting a soft landing, right? That's jobs only. I mean, JOLTS actually showed, I think it was the steepest decline in job openings, which isn't very bullish, but overall there's still 1.5 open jobs for every unemployed person. And even though temporary work is also rolling over, which is actually a very recessionary cycle, but you see that a lot of companies actually turn temporary workers into full-time employees because it's so expensive to get new employees in certain areas. And then obviously, NFP numbers today, you got somewhat slowing wage growth. And even though you got a pretty steep revision, you just talked about revisions of the past 2 months, which is quite interesting. Household survey showed, I think 220,000 new jobs. It's a softish landing, right? The Fed is seeing this, wage growth is moderating, but still no very bearish data. So I think we need to look, beyond employment data. I think the bigger trend is bearish. If you look at, as I just said, temporary work is cooling off very, very quickly. And historically speaking, I think in 100% of the cases where this happened, we were entering a recession after 2 or 3 quarters. So I think this actually aligns with the gross domestic income we just talked about. And I think Adam mentioned that gross domestic income had been negative for like 3 quarters, which is I think 9 months, if my math is correct. And the ISM manufacturing index has been negative, since today for 10 months. So it all lines up, right? Temporary work is slowing down. But I think just NFP numbers, I usually ignore them because it doesn't mean so much. And even, there's so much data out there. Hourly wages actually down a little bit. But if you look at Atlanta Fed data for job switching data and all these hourly wages, they're actually up again. I think people who switch jobs get an earnings boost of 6.4%, which is up from 6%. So that's not what the Fed wants to see. So I think if I were very bearish, I could make a very bearish case using this data. If I were really bullish, I could make a case. But I think in general, it's not a pretty picture. It could it could slow down really, really quickly if you see, cracks in housing and
Well,
whatnot.
a few weeks ago, we saw the Michigan Consumer Sentiment Survey, which
Yeah.
I don't really put a lot of stock in, but evidently the Fed looks at that and things are starting to turn sour there as well. So
Yeah, I think Michigan is interesting. I think last month it went down again. In the month prior to that, it had a really steep increase. But if you break it down into the bottom half and the upper half, I don't know exactly what they use, but only the higher income earners, actually push it up. So it's actually what we talked about. The lower spending class is still in trouble, and it's now even worse because the entire index went down again. So I think it all
Yeah.
lines up with the bigger picture.
It had its biggest drop in like 2 years. It's the
Yeah.
largest month-over-month drop. And you bring up a good point into what you and I were talking about earlier with the wealth inequality in the country in America, like the whatever upper, middle, bottom poverty level. Mariner Eccles, who was FDR's former Fed chairman, I know this might sound kind of obtuse on this, but he, in his memoirs, when he was reading back on how they handled the Great Depression, there's a really good chapter in his book where he has a great quote. He says, "Mass production requires mass consumption." He said, and when you have the wealthy, the money flowing to the few, the hands, it acts like a huge suction pump because it's taking buying power from the mass consumer. He's like, the top 10% are net savers, not net consumers, hence why they're rich. So they essentially, the bottom 90% has to borrow credit to keep their spending going because their real wages can't justify it. And then Mariner Eccles at the very end, and as soon as the credit stops, the game ends. And I think it's really important for today too, because we have wealth inequality is pretty bad. It's the upper middle class income right now that's acting like a suction pump. You see the people post data points. They're like, oh, the Fed is paying so much interest on bonds, it's going as a net asset into the economy. And it's like, yeah, but who's getting that money? It's, the bottom 90% are net debtors. They have more debt than assets, usually mortgages, student loans, all these things. So it doesn't help them. They're not net savers, right? Any money they have left over that's disposable, they can't save relative to parking in debt. So if the rates go up higher, that it's paying off on bonds to the rich, that means consequently credit card rates have gone up, auto loan rates have gone up. So the net debtors are actually feeling that, it's offsetting it. So I think it's important actually going forward, seeing how the dynamics are between the income groups. And we've seen the bottom 75% pretty much get squeezed out over the last 20 years. It's dropped pretty bad. So I do think this is going to play a role in demand later. And I think that's why we're going to see continued pressure from like the administrations to boost wages and keep doing things like buy now, pay later. You know what I mean? Just roll over the student loan pauses and, deferments, all these things. They're going to just having to keep rolling the credit game over to keep that consumption going because otherwise they can't get it.
Yeah, we're seeing that now, Adam. I mean, literally, you're seeing that right now, and it's probably like the second or third inning of what's been going on. They're just trying to keep this locomotive going, while the top 10% of earners are just kind of holding back at the moment.
Yep.
Would you agree? When you look at construction spending, I mean the Inflation Reduction Act, I think that's one way to actually boost the income of lower wage earners. I mean, I think construction spending and manufacturing alone is like 200 billion on a seasonal annual basis. I think that's one of the reasons. I'm obviously, onshoring technology is important, but I think that's one major driver of income in the lower income levels. Yeah, but I wonder what happens if these construction projects are finished. I mean, 200 billion on an annual basis, that's massive. I mean, I think if these run out and they don't have new spending, I mean, these factories don't need to rebuild every year. So I think that could be an issue at some point. Or am I just overstating this?
No, you're. I think you need to divide it in two separate parts. One is, industrial scale construction where government contracts last 10, 15 years, so on and so forth, versus the smaller scale construction of homes, remodeling, plumbers, electricians, so on and so forth. The problem is, as those prices go, as those wages have gone astronomically high, that hits the consumers. I mean, it costs almost double to redo a kitchen nowadays than it did 5 years ago. All those expenses have to be calculated in, and what the consumers can do going forward.
I got to tell you, I have watched more YouTube videos on how to do things around my house and with my air conditioner and with my sprinkler system and all that stuff because these guys, you're going to spend at least $600 for somebody to come out and fix something.
Yeah, if you're handy now, it goes a long way.
That's doubled over the last couple of years, right? And so the other part of this is, even at restaurants, I have some friends who have franchises, and it's really hard to keep staff. And when they come, wages have not gone down at all. So I'm in Texas, I'm not on the coasts, but those hourly wages generally are doing very well. So Leo, this challenger data and the employment data you're seeing, is this mostly impacting, say, small and mid-sized, say, non-services, like say, restaurant jobs, tourism jobs, that sort of thing? Or where are the layoffs hitting?
It's actually, I mean, if you look at JOLTS, it's a companies who cut vacancies. It's mainly in services. I think professional services were mentioned, and I think that makes sense because with wage inflation, a lot of these blue-collar white-collar jobs will actually see. I mean, we are still far from automatization and AI adoption. I mean, that's still a long way, but we are starting to see the beginning of this. And I think if inflation remains high enough on a long-term basis, you're going to see more losses in these white-collar jobs than blue-collar jobs. I think that's one of my theses, especially if economic growth, returns in the future. You will see a lot of demand for just the jobs you just mentioned. And yeah, I think that's the main takeaway.
So we see things kind of grinding ahead with these kind of lower level jobs, but we see weakness in kind of the mid, high, and higher level jobs. Is that fair? Is that what you're seeing?
Yeah, exactly. And also what you just said in Germany, it's quite interesting. I mean, Germany is now actually starting to see an increase in unemployment because of the weak manufacturing sector, but still it has a lot of structural labor shortages, and that's we didn't have that in the great financial crisis and in these other recessions, but now it just, I mean, the government also plays a major role in these issues. I mean, I think they just boosted unemployment income for the unemployed by 14% in Germany. You're just basically paid to stay at home, and I mean, it was bad during the pandemic, but it's still very bad, especially in Germany. I think the average family, if you have 2 or 3 kids and both parents are unemployed, I think you have 35,000 euros per year. That's after tax, and the government pays for your heating, electricity, rent, everything. So I think to solve these structural issues, I mean, we really need to fix these things, but that's probably not going to happen anytime soon. But it's just what we're seeing now. This mix between pressure on employment and structural labor demand.
Okay. So Leo, we started the show talking about how like these extreme views, either extreme positive or extreme negative. But what I'm hearing from you on labor, to be honest, it doesn't really sound that good. Is the labor picture worse in Europe than it is in the US?
I would say so, yes, because I think the most important labor are the ones that is most value. In Germany, for example, which is the industrial heart of Europe, it's just the entire automotive supply chain. I mean, these people, they've made good money for decades. They got special bonuses. They made really, really good money, and that's ending now. I mean, there's not really an incentive for companies like Mercedes or BMW to invest in Germany anymore, or in Europe in general, because I mean, they always used to invest in Germany because they were a large market for automotive demand, but they stopped caring about it. I mean, I think all German automotive companies, except for Volkswagen, are now saying, we're going to drop cheaper models. We're going to focus on margins and sell in China and the US. So I talked to someone who is now building homes in South Carolina to lease them to BMW executives. And that's happening everywhere, they're just moving out. And if these jobs start to fade in Europe, that's going to hurt. And we're already seeing this now. The chemical industry is another one. I mean, people in the chemical industry, Germany is a country with relatively low wages on the receiving end. I mean, employees pay a lot in Texas, but the chemical industry has always been like an industry with very, very high wages, and that's going to end. So I mean, I'm not saying it's going to end for everyone, but growth is gone, definitely, and people are divesting. So for the next few years, we're going to see some significant changes in European employment. In the US is in a much better position. It's not even close, in my opinion.
Interesting. Okay.
Just to add on that real quick, Leo, don't you see that as a problem? Because I agree. I mean, the problem with, China, Germany, Japan, or the Eurozone, essentially the 3 of the 4 largest economies in the world, they have no demand. They have no internal demand. They've all depended on exports for the last 30 years. And, they all run these chronic surpluses. And that's kind of the problem. I was debating about this like a year ago with a gentleman in a Twitter space, because I was like, look, China cannot consume what they make. Germany can't either. They don't have the demand in that economy. So you have to depend on exports to get that growth. That's where it's going to come from then. Because if you can't consume it at home, you export it abroad. But once the exports start declining, and US real imports of services and goods is actually negative year over year now. It's like -5%. And I just want to put for the record, it's only ever really drops negative when there's a recession. So that's another signal for America. But we're seeing that in the reflection of data with like China. China's exports are down double digits. The only reason they run a surplus is because their imports are down even further. But with these other economies not able to consume what they make and they're trying to offload it, they're stuck with either deflation and rising unemployment. And we're seeing that in China, youth unemployment. They're not even posting the data anymore because it's gotten so bad. And I think Germany is probably going to be right behind them. Like Japan's recent GDP was pretty big, but one thing to note, it wasn't from their domestic economy, their household share. Yeah, it was literally external demand. Their internal demand actually declined quarter over quarter. So I do think it's an issue because if the US, it's usually the US and the UK are the big 2 deficit running countries in the world. If they start slowing, which we are seeing now, like everyone's like, oh, the US trade deficit narrowed. But to me, that just says like, okay, that means the US is obviously pulling back on goods. Like Albert was saying, we're moving more towards services. But that's going to affect these economies far more because they have no outlet for those things.
Yeah, Brian, Adam, that's correct, and it's compounded by the fact that the Europeans, specifically Germany, has just made error after error on social and economic policies for the past 3 decades. I mean, when Merkel was in power, she just gave away all of Germany to the Chinese with no foresight to see that they're copying their stuff and cutting into their exports. Now the European Union, which they should have done, and I think we talked about this like 2 years ago, Tony, they should have pivoted towards Latin America and Africa, using their old school networks and rebuilding those supply chains for their products to sell out. But instead they didn't. They got lazy. They got used to free money, and then here we are.
They make it even worse, Albert. I know that, the EU, they're basically saying we're not going to buy soy and corn from Brazil if they cannot prove that it wasn't part of deforestation. I mean, nobody can prove that. So they're basically saying, then we won't buy much needed agriculture products from South America.
But we hear principled European statements all the time, right?
So, yeah, exactly. They will still do
sorry to be skeptical there.
Yeah, but it's true. But what Albert said, I mean, I think this week, the IAA, the biggest automotive show in Europe, is starting. I think it's in Munich this time. 60% of car companies are actually foreign, with most of them being Asian. And they're exporting so many cars to Europe right now. I think China is exporting more cars than Japan. And the quality of these EVs is actually quite good. So that's another issue. I mean, not only is Europe, losing exports, but they actually, there's more consumption of Asian cars right now. So that's, and the production, is in Asia. So that's just, I mean, total worst case.
What you guys are telling me, I mean, what it sounds to me is we're going to have Europe and Asia continue to export deflation. Going back to our earlier discussion, that will put serious deflationary pressure on goods. And so I would think in a quarter, 2 quarters, we really start to see some of these goods in Western markets, especially in the US specifically, goods prices go down dramatically. That's what it says to me. I could be wrong here, but I think this working thesis has some legs to it. While in the US, we see persistent wage levels. I don't know, I could be wrong, but I don't know that we're going to see wages dive like we've seen in some previous recessions.
No, 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 no. We're not going to see wages dive. This is a political. This is a political game that they wanted. They want wages up. It's been, listen, it's been 40 some years since the U.S. Worker has had like a wage increase in reality,
Yeah.
and they're getting it now, but it's coming at a cost.
Okay, so we have deflation in goods. So a lot of these companies, as you were saying, Albert, earlier, these companies that have goosed their stock prices based on margin jumps, they're going to see some pain, right?
Oh yeah. Oh, without question.
And so for consumers, if we're seeing goods deflation, we may actually have to see, and I'm not really in the Fed's going to ease camp, but we may actually have to see that the Fed maybe slow down QT or something to make things easier on consumers.
Oh yeah, it's an election year. It's an election year. Of course they're going to do that. They're going to spend. They talk about cutting, spending and whatnot. They're not doing that in an election year. They're going to cut QT. They're going to boost the markets, boost inflation because they know it gives tailwinds to earnings and make everything look all hunky dory for the 2024 election.
Okay, so here's the biggest concern that I have, and this is the segue to our final segment on housing. So the most significant wealth effects for Americans are felt with the value of their house.
For boomers, yes, for boomers.
For boomers and Xers, I believe. Millennials don't own houses. I'm kidding, but housing is the biggest wealth effect, right? I mean, now that crypto is kind of dead, it's housing really, even for millennials, I think. So now we've seen. We have this chart from on the Case-Shiller home price data where we show from peak to trough, houses in San Francisco are down 17%. And in Seattle, they're down close to that, almost 17%. But many of these home prices are up 40, 50% from March of 2020. So, Adam, you were talking about U.S. housing markets earlier this week, and they seem to be breaking. They're off some amazing highs. If you look at, this U.S. housing is still up 43% on average from 2020. I mean, that's insane, but it's good because it's helping people spend, right? So, you posted this this other tweet about how the Fed has broken the market based on their MBS purchases, both on the supply and demand side. So how is the Fed's kind of destruction of those markets likely to be resolved? Is there a possibility that we can have a soft landing in housing? I mean, especially going into an election year. I mean, those are serious issues for voters. So what do you think happens here?
So two things on it, and I agree. I think the housing market's been completely screwed by, to put it nicely, between the Fed and the government. After 2008, essentially the government, we all know they went out and they were like single family zones, right? HOAs, greater bureaucracy. It effectively restricted supply of home construction. So right there, you take away the supply, you already put a floor under the price. Then you have the Fed, which in my opinion, financial historians are going to be scratching their head looking back at the COVID era about the mortgage-backed security buying, the $2+ trillion they bought. I think they're literally going to look at it and be like, what the hell were they thinking? Because when the yields were so low, how those mortgage-backed securities work, they're buying them. When yields drop, you can refinance, right? And you can down pay it faster. But they bought them all at like record low yields. Now yields are going up and they're not repaying them. They can't refinance them to roll the mortgage-backed securities older. So they're stuck holding them longer. And as we saw with like SVB, they're pretty illiquid, a lot of them, unless you plan to hold them until maturity. So I really think that you're seeing it on both sides. The government needs to get out, allow more construction out of the way. There's actually a good a report that came out by Brookings Institute I found fascinating a year ago. the cities with the strictest building laws have the highest home prices, like Portland, San Francisco, etc. And it creates a dual incentive, right? Like they want to build properties. And it was kind of like you were just saying, it's a politically sensitive topic. But if you're a homeowner, the last thing you want is more supply because it weighs down your home price, right? If you just took out a $500,000 mortgage and then the government's like, hey, we're going to build more supply in the area, that could weigh down your home value relative to your debt, you're not going to vote for that. I mean, right? I mean, so it's like you create these perverse incentives against each other. Like, hey, we're trying to do some more housing to get more individuals in. Oh, but the people who are voting don't want that because then it'll weigh down their home prices. So it's created this really toxic combination that there's really no easy way out of. And I think that the Fed, I really don't understand like the post-COVID thing again. If anyone has better insight, like I get it, people are in panic, but the government already like paused mortgage deferments, and they essentially paused mortgage payments. They gave out stimulus, so I didn't see why the Fed had to come out and say, hey, let's just buy 2.4 trillion in bonds, mortgage bonds, to pour gas on the fire. And as a wealth effect, it's created, definitely like you said, it's in theory, yes, rising asset prices is meant to stimulate more consumption, but there's a catch to it, because you can only spend more is if you borrow against your house or if you sell your house. But the problem is if you sell your house, there's no net difference, because if you sell your house, you're probably gonna have to buy another house, and the prices are up everywhere. So that money just shuffles from one hand to another. It doesn't really leave you with like a massive amount of purchasing power. So the idea is that, hey, you can borrow against your home because the asset price went up so high. That creates new deposits, which is inflationary, because if you hold the asset and you're borrowing against it, you're creating more demand while holding on to what you already have. I don't know if households want to do that. There is a huge amount of home equity that could be borrowed against, but I still think individuals remember post 2008, and they're cautious about doing that, like borrowing against a.
I don't think they remember. I don't think they care. I think we're going to see deregulation of borrowing against home equity.
We could see that. You're right. So that's my big thing, because I think the consumer right now, consumer credit change, like I was saying earlier, it's been fading for 7 months. It's just been sinking. Bank loans, year over year, auto loans are negative. It's the first time it's actually been negative since they started counting the data year over year. Loans and leases are down half. It's already below pre-pandemic levels. Bank credit is negative. It's only been negative since 2008. Mainly it's from securities, obviously their bond holdings, but also 75% of that bank credit rating is their loan book. So banks are tightening lending, and I don't know if individuals want to borrow at such high rates against their home when the whole market, there's essentially an illiquidity pocket, right? You have people who don't want to sell because they're locked in at a sub 3%, and you have individuals who are wary about buying because of the high prices. So something has to give, one or the other. Otherwise, we're just going to sit in this illiquidity pocket. And I think that's something that the government broke in the housing system for sure.
You know what I would say? You know what I would say, Adam, and what some bigger minds than me, perhaps yourself, in those data is, I would look at the actions of who is it, BlackRock, that bought up so many homes and have them in some portfolio. For what reason, and what returns are they? What are they doing with these things? And a lot of them are not even for rent; they're not for sale. So what are they doing with these things? Are they acting on behalf of the Fed or the Treasury or whoever to like help assist on those mortgage-backed security purchases? I don't know. That's something that I would be really keen on hearing who's got some kind of perspective on that.
It's interesting you bring that up, because I'm them helping the Fed. That could be a good angle, actually. I'm going to look into that. But I did read a good paper from the Chicago booth, Economic Review, and they were essentially showing that there's a massive savings in the U.S. post 1980s. Like there's just been like the top 1%, the corporations, the current account surplus economies, they have so much savings that when it floods into the banks, it's crushed return on investment, just because you're obviously more supply than demand. And the banks, they obviously more savings they owe interest on it. That's always compounding. So it's like you always have to pay more, and if it keeps getting rolled over. So they had to be more creative with finding outlets for this money, for some kind of return to pay these liabilities. And they said housing became attractive after like 2015, it started becoming more attractive. They said like big institutional money that were just drowning like trillions of dollars, like BlackRock controls, Vanguard, they have literally trillions of savings that they owe. They had to find places to put it, and they were looking at housing for a way to have like any kind of appreciation, but also to rent. But you're right, we haven't really seen them renting it out.
So do you think there's any serious option if you use housing other than kicking things down the road a few years? I mean, are we really going to see mortgage rates continue to rise? Because if consumers are as crushed as they are right now in terms of their liquidity, they're going to have to refi, and they're going to have to refi at higher rates. We hear all these great stories about people at 3%, 30-year mortgage rates, but consumers, according to the data, seem like they're running out of money, so they're going to have to refi. So to me, it tells me that there's going to have to be some sort of deregulation around home equity lines of credit, so people can keep their 3% loan, but they can get incremental loans at this higher rate or something like that. Does that seem plausible?
Yeah, definitely. I do think it's plausible. I mean, because something has to give. You either have to have lower prices through more supply, but like we were saying earlier, that's going to be a bitter pill to stomach for anyone who owns property, who bought property. Like we're seeing in the auto market already, right? Like negative equity is already soaring for anyone who bought. And if you do refinance, which is another problem at a higher rate, it's very deflationary long term, because you can only do two things with your money: spend or save, or delever, or pay down debt. So the higher your interest rate, that's less money or less disposable income for you to spend,
right? Which
will trickle into other sectors. And I think that's kind of the big problem right now, is that there's a lot of debt, there's a lot of higher interest rate debt, revolving credit outstanding is pretty high. I don't know if you saw recent data from the Fed. The conference board. The delinquency rates on credit card, revolving credit, auto loans, and they're already way past pre-pandemic. They're the highest they've been actually since a decade ago. So you're having more defaults. I don't know how much more individuals can handle it, because you're getting squeezed on, mortgage. I mean, assuming you're locked in. But now you have student debt, then you have your credit card debt, personal loans, etc. So I don't see how they can really get out of it easily. And I think whichever one they try to choose, it'll be politically unpalatable. So I'm assuming they'll just try to kick the can down the road, or like you said, there's gonna be some kind of deregulation, some kind of reimbursement, some kind of, the government's gonna figure out something that they're gonna just say like, hey, we'll put it on the taxpayer, and just to keep the game going.
Yep. Very good. That doesn't sound very, it doesn't sound like we're ending on a good note, but I think we're ending on a realistic note. Housing prices are very high, and they're way above where they were a few years ago. With interest rates rising, this rarely ends well, but I think we're going to see, the Feds try to extend this as long as they can, and they'll come up with really interesting ways to do it.
I actually heard that bigger buyers, institutions, I don't know about BlackRock, but they're actually building a war chest, because they expect a situation where somewhere down the road the Fed is forced to cut rates more rapidly than expected, with elevated unemployment, because at that point you can borrow really cheaply from bigger projects, and you don't have competition from people who are unemployed. So I think you will see massive institutional buying if that scenario were to occur. And that's actually why I'm looking to buy home builder stocks. But I think that's the next bull case for this industries. But I agree with everything else.
Leo, I think you're probably onto something. I think that would be very difficult to allow in an election year, because America.
Or in an election, yeah, but I think after next year, but yeah. Not going to, as Albert already said, they will probably have already planned out how next year is going to go. But after that, who knows?
Yeah. At the end of the day, BlackRock will win. We all know that, right? But
Yeah.
maybe not. Maybe they'll be a little patient in 24.
Sure.
Sure. All right, guys. Hey, thank you very much. Thanks for all these great insights. I really appreciate your time. This is incredibly valuable. So have a great weekend. Have a great week ahead. Thank you, guys. Thank you.
Thanks.
Thank you for having me.
That's it for this week's episode of The Week Ahead. Please don't forget to rate us and review on whatever platform you are watching or listening to this. Thank you.